Okay, everybody, welcome. Appreciate those of you that on live being patient as I had little technical difficulties, but we've got it all up and running right now. Excited to see you guys in here. I see we've got several already checked in. If those of you are starting to pop in, feel free to say where you're from. I see Nate here from California, Aaron from Iowa. Good to see you again, Aaron. We got Danielle also from Iowa from the other side. We got Sray from Hawaii, Francois from Charlotte. So awesome. So glad to have you guys. Jessica from Alabama, ma'am, or whatever, however you want to say that, right? So Alabama. So definitely good to see you here today. And all the rest of you that are here too. Here's the thing, guys. Like, I know that there's a lot of uncertainty in the world today. We've got so much news about Doge going on. I just did a podcast on that yesterday. We've got all these uncertainties about these tariffs and what that's going to do and how's this going to affect our entire lives. And inflation's still sticking around, right? But what happens about this or that and taxes? And I know it's just a crazy, crazy world. And so I want to talk about this wealth shortcut, right? And this is not get rich quick by any way, shape, or form. I mean, the shortcut means you can actually create wealth while you're still alive. You don't have to live to age 100 plus to finally see that happen, which is true for most people. So, and again, I'm sharing from my own experience as well. So I'm going to show you, and I'm going to give you kind of a little extra bonuses here too, but I'm going to show you how you can actually store your savings where you can get a higher return than banks, yet safer than stocks. Also, it's tax-free. It's protected from sue-happy creditors and predators so that your money is protected. You don't have to worry about it being taken away. And of course, even better, especially if you want that wealth shortcut, it's a passive income booster that'll pay you twice, shaving off years towards your financial freedom, just like hundreds of our clients and I have already done over the years. That's something you want to see. That's exactly what I'm going to show you. And even for those that might have seen something, say, I think I've seen something like this before, just so you know, I've added a few new things just for you. So Christopher from Florida, welcome. All right, just so you know, of course, there is going to be a free consult ahead. I'm not pitching you and selling you anything that you're going to have to pull out your wallet, nothing like that. Like, really, I'm going to be offering a lot of education, a lot of things to kind of help you understand where we are today and what you can do to actually really beat the masses, right? Like, beat what's happening to most people where they aren't in a good place financially. And it's getting worse and worse every single day. So I do have a free consult that's coming up that you guys can actually take advantage of at the end of this. And I'll give you a QR code later on. Now, my inspiration for today is, if you guys have known me at all, like, I talk a lot about my dad, right? My dad was a hardworking, penny pinching saver. He says frugal, we said cheap, right? He was that guy that was always just trying to, just make ends meet. He was always trying to save. He was always trying to put money away. He was the one that taught me to be the same way too. In fact, he's kind of the inspiration for me because it wasn't the inspiration from a good standpoint, but more for what I didn't want in my life, right? He would always talk about how we can't afford stuff, right? He would talk about things like, hey, what do you think? Money grows on trees? I'm not made of money, just all those kind of things you'd hear. And even worse, he would even say, Chris, this job is going to literally kill me. I will die from the stress of this job, because he'd already had strokes in his 40s, heart attacks in his 50s. He knew that that job was basically a death sentence for him. How many of you might feel like maybe it's not quite a death sentence, maybe it's not that extreme, but maybe you feel like maybe your days are wasting away. Maybe you feel like your time is running out because maybe what you're doing isn't quite working. And so that affected me growing up. And so when I went to college, Aaron, shout out to you since you were my roommate. But when we went to college, right, my initial response was, maybe I should go into like business consulting. But I figured, if I'm going to do that, should I have real life business experience? So I actually took a sabbatical from college right before I got my bachelor's. I said, I'm going to take a year off, get some real life experience, and then come back, and then I can actually be a good business consultant. However, yes, I will put that in there. Yep. So anyways, here's the issue though. Like, as I started going to that, looking for that business, being a financial advisor was the thing that kind of connected with me, because what I saw here was this, is that as a financial advisor, I could actually learn about money. I could actually learn what to do. How could I invest? Essentially, how can I make more money myself, not just in my business? And even better, maybe I can give my dad some of his life back. Maybe I can get him to say, I'm not going to die working. Maybe he can even have a few extra years of peace and tranquility, right? And some assurance that he's okay. So that's why I became a financial advisor. Did that for 4 years. And I drank the Kool-Aid, right? Like, I was all about stocks and mutual funds, and that was the only way to go. And I would show the charts to show you that stocks were the only way to go and real estate sucks and you should only put your money in the market and I'm the guy to do it. Well, 4 years in, my dad says, well, when are you going to advise me? When are you going to actually sit down with me? And so I sat down with my dad, looked at his finances. And after all was said and done, I said, Dad, you've done an amazing job. You've stuffed your money in your 401k. You've got the company match that you've got coming to you, of course, over these years. You've paid off all your debt, including your house, 100% debt free. You are like Dave Ramsey's poster child. And yet, Dad, if you want to retire today at 61 years old, you're going to have to die in about 5 or 6 years because you'll run out of money. You'll be gone. It'll be gone. Now, when he's like, well, what do I do, Chris? What else can I do? I said, I don't know. You've done everything right. I really don't know what else you could be doing right now, because if I try to throw you in this stock thing or that thing, what if the market goes down? By the way, guys, this is 2005, just a few years later, the market did go down. So I was at a loss. I didn't know what to do with him because I didn't want to lose. I didn't want him to lose. He didn't want to lose either. He didn't have enough time to lose. He didn't have enough time to get it wrong. He had to get it right. And when the student's ready, the teacher appears. That's when I started to realize that I looked for evidence and I found people in real estate, people that did real estate investments. They were in their 20s and 30s financially free, unlike my dad in the 60s, who did everything right, and yet it still wasn't enough. And sadly enough, me as a financial advisor was on the same path as my dad, going down the same freaking rabbit hole, hoping that if I just stuff enough money away and I'm cheap enough the rest of my life that maybe I'll save enough to be able to retire, maybe before I'm 60. And the problem was it just hadn't worked. Hadn't worked for me, hadn't worked for my dad, even though he had financial advisors helping him. Didn't work for all my clients, even the ones that had financial advisors before still couldn't be financially free. And that's when I realized when none of them were financially free and neither were the financial advisors financially free, there was a problem. There was a big, big issue. I couldn't teach anymore. I had to choose between my integrity and my pocket or my pocketbook, right? That's what I was really trying to figure out. I was like, do I stay in this and keep lying about it, or do I leave? And I left. I went to do mortgages, but I also wanted to learn what these guys learned about real estate investing. And so even though I'm teaching you a strategy about where you can save your money, where you can put it besides like a 401k that could actually be losing money over these next 10 years, instead of putting it there, I'm going to talk about a place you can save it, but also what else could you be doing with that money that could actually get you to wealth and financial freedom decades faster than the path you're on right now. So let's talk about these challenges that we're dealing with today, right? I mentioned the stock market, of course. We've got big issues with this because one, you've been taught I've been taught even when I was a financial advisor, and you've probably been taught for your adult years that the stock market does 12% a year, right? Remember that magic 12%? Even Dave Ramsey says you save $100 a month for the next 40 years, you have 1.176 million. So you should not retire broke. First and foremost, in 40 years, what's 1.176 million going to be worth, right? What's it going to be worth after 40 years? Inflation doubles about every 12 to 15 years at least. So one, that's going to feel like a few hundred thousand. But two, guess what? Dave Ramsey can't freaking do the math right because he got the number wrong. It's actually 979,000. He was $200,000 off but again, people just believe it because Dave Ramsey said it. But here's the other issue. Here's what the stock market's actually done in the last 30 years as an actual average rate of return. 8.74. And this is one of the best returns I've ever seen. See that little line down below, that red line? That's called a trend line. For those of you that are stock traders, like I used to be, by the way, you use the trend line to figure out if something's overvalued or about the right time to buy. When it's getting close to that line, it's a good time to buy. Last time it did that was about the 2008 recession, right? Look where it is now. Look how much higher it is. Really now the S&P shouldn't be much higher than about 2,200, 2,300 points. We're about 6,000, guys. It's way over. So one, we've got one of the best returns we've had in 30 years, and it's only 8.74%. If you happen to be lucky enough to pull off a 9% rate of return, look what you get. If you use Dave Ramsey's $100 a month, you don't get 1.176 million. You got a third of it at 424,000. And most of you would be dang lucky to ever get that high of return, especially if you're using 401ks, which have high fees and bad performance. Even with the match, you barely make up for that bad performance. So that's the big issue. This is why so many people, and I showed like after inflation, if it was only 4% inflation, I'm going to talk about that in a little bit, it's only like having 88,000 bucks. Whoop de freaking do, like that's not going to do anything for you. You live on 3% of 88,000. That means you live on less than 3,000 a year we've been trying to save $100 a month for 40 years. Also, Buffett right now has been selling off shares in Bank of America. He's been selling off Apple stocks. He's been liquidating his out of the stock market right now. Why are we still in the stock market when he, the guy that's supposed to be the greatest investor of our time, has been liquidating stocks for the last year? And even more so, even though this article I snapshotted was actually just a few weeks ago, he had 325 billion. He now has, as of a few days ago, 334 billion just sitting in cash. Now he keeps telling everybody, hey, that's still only a quarter of our cash. But think about it. He's a guy that actually buys into American businesses long term, and he's liquidated all but 3/4 of it, right? Or sorry, all but I mean 3/4 of it's still in stocks, but a quarter of it is just sitting in cash waiting for something. He's waiting for good value, but every financial advisor keeps telling you, keep stuffing money in that market, don't they? Right? And here's even worse. Vanguard even came out recently that says their anticipated 10-year annualized return, their average return they expect per year is between 2.8 and 4.8% per year. Yeah, you heard that right. Between like less than 3 to less than 5% a year is the guess over the next 10 years. Wouldn't you think I'd be better off in a CD? If I got a 5% CD, I would be better off and take less risk in the market, right? By the way, there's a better way to do it than even a CD. Let's see. Yep. Going on this next one, just to talk about the Buffett indicator. They talk about comparing the stock market value to the gross domestic product, right? The health of the economy, the US economy. Notice where the line is now. So the middle line, that little black dotted line you see right over there, right? See that one's down really low. That's like down around the 100% where it's supposed to be. Notice where the line's over 200% above where it should be. For those of you who are all about statistics, means 2 standard deviations above, right? Which means, in simple terms, it's way too freaking high, right? Way, way too high based on index. And just so you know, that GDP, did you know over a quarter of that GDP was based on government spending? So what happens to all of a sudden the economy and the value of the stock market when all of a sudden they realize, oh, the government spending is going to slow down because they're now trying to make massive, drastic cuts right now as we speak? What do you think is going to happen? GDP is going to be lower, and if the stocks are still up here, that little line is going to skyrocket way above, and then it's got to go back into balance at some point. This means essentially your stocks, if they went back to normal, your own mutual funds, your retirement accounts could lose 2/3 of its value right now. 2/3, right? 2/3. Imagine losing 2/3 of your money right now. That means you got $300,000. You're going to be left with $100,000. How long you be in it for the long haul, as they quote unquote say, waiting for that to come back? You see an issue here. You see why, I've been warning people for years. And I know it sounds like I'm a crazy person because I have been doing it for years, because look how far above it's been for so many years, even since 2020. By the way, in 2019, the end of 2019, we were predicting that 2020 would actually have a stock market correction, but it didn't because the government pumped more money in and overinflated it to where we created an everything bubble, right? And that's the part of the challenge, or challenge is, I love how that S didn't work out on this thing here. I told you I had technical issues leading right up to this. But look, the US national debt, right? Now it's about 36 trillion. Now I think it's almost bordering 37 trillion right now. And it took less than 4 months to go from 35 to 36. Again, massive government spending. And what does that do? That means they got to find a way to get taxes. Yeah, they can keep making cuts, but notice how everybody keeps trying to block them from making drastic budget cuts, because that could really tank the economy potentially, right? Kill jobs, tank the economy in good ways. I think really the Band-Aid needs to be ripped off anyways to some level. But again, if they're thinking, well, where else can we get money to be able to afford for Social Security in this place and this place, right? Hey, why not go for your 401ks and your IRAs? Because they can change the rules on you whenever they feel like, and you don't have a say in it. Because the truth is, if you have a 401k or an IRA, the government is the controlling partner. They control the rules. You are just a benefactor. In fact, if you ever try to look at your 401k, you'll realize you're actually not the owner of the 401k. You're the benefactor of it. The IRS is the owner. They're the ones. The US government is the one in control of your retirement plans. If you trust the government, great. I just think it's a bunch of crap, so I don't. Also, we got interest rates, right? Interest rates have been, of course, now people thought, oh, it's going to be coming down. Now they're like, well, it could be higher for longer. Now they're saying, well, man, if the economy does crash, then interest rates will finally go down. Oh, yeah, well, that's great. Yeah, let's all get laid off, and then we'll think we want less interest rates. That's the thing. It's like we have to have some massive stuff happening in a bad way for even interest rates to go lower than they already are. They're already pretty dang high for what we've been used to. I'm not saying they're high historically, but for what we're used to, it feels like a lot, especially if you're trying to buy a house nowadays. But look at this. Here's the thing about inflation too. We got inflation that's been kicking our butts. Now everybody's like, oh, good, it's coming down to 3% finally. It's not quite 2, but it's down to 3. Well, guess what? Shadow Stats actually took the original way they calculated inflation before. Did you know that ever since Jimmy Carter, ever since, and it's been every single president since, they have jacked with these ways that they calculate the inflation rates? Why would they do that? Think about Social Security. I just mentioned that, right? You notice how Social Security, they always talk about it going bankrupt? Well, the way that they have to keep giving you annual raises on your Social Security, for those that are retired, it's based on the consumer price index, on the inflation numbers that the government reports. So wouldn't it make sense if you were a government official saying, how do we make Social Security last longer? Well, we already know inflation is just inflation, but what if we calculate inflation differently to where it's not as high? So then our Social Security funds can last longer and we can kick the can down the road to the next politicians, right? That's what's been happening ever since the late 1970s. That's why this guy that does shadowstats.com, he was the one that was actually calculating for airlines based on the inflation numbers the government were presenting. But then all of a sudden, the airlines were losing more profits. And he couldn't figure out why. He figured out it was because inflation, because they were lying about inflation. They were adjusting some numbers, and the real life inflation was much higher. So the truth is, based on this, usually the inflation that the government reports is about 7% lower than real life. Now, I don't want to depress you too much, because that means if you're at 3%, that means you're close to like 9 or 10% right now as real inflation. You probably already feel it. But the problem is, again, it does depress people, because if you're only making 7, 8, 9% of the stock market, you realize you're going to lose inflation anyways. So hopefully you're depressed, because good. I got some more depression stuff. We got banks too. Banks have been failing as well, right? We've had issues with Silicon Valley, but then somehow randomly we had Signature Bank, Silicon Valley Bank, and a few others go bankrupt, right? And then all of a sudden nothing's going on wrong. Are there some bigger issues down the road? Especially we have this, right? You have the FDIC saying, hey, we only lost 2 banks. Well, 2 banks so far, right? That's the problem. So that's the thing. Where are banks storing their money? Well, guess what? They're not storing it in the banks. They're not putting the money there. They're not leaving it in the banks. In fact, we've had people on our show that said, no, I know people that own banks and they store money somewhere else, which is what I'm talking about today, right? By the way, Walt Disney did the same thing. When he wanted to create Disneyland, the happiest place on earth, he actually had to use his own cash, his own personal bank, to be able to bring in enough cash so then ABC would bring in enough to create Disneyland. We also had, of course, Ray Kroc. When Ray Kroc bought McDonald's, he had to pay the executives. He had to dip into his own reserves to do that, right? And what is this tool that they've done over the last decades, even hundreds of years they've been using this? And even Eddie Wilson, who's been on our show now about to be twice, because we're releasing his episode, even Eddie Wilson said, hey, I've been putting money into this as well. And in fact, my grandfather, who ran a bank, taught me how to do this. And it's this infinite banking, right? Infinite banking is the thing. Now, I know some of you guys, if you've heard this before, it's great. That's wonderful. I'm glad you have. But I'm telling you here that infinite banking is the answer, especially with high stocks that are way higher than they should be. And that's why they're not predicting any real growth in the stock market, because there's nowhere for it to go. That's why they're also seeing issues with taxes, all this kind of stuff, right? Really, infinite banking is like this tax-free, high-yield savings account. I talked about before, you could put money in a CD and possibly beat the stock market and do it safer. But guess what? You can get potentially just as high returns with no taxes, storing your money, literally just having it inside this infinite banking. But I will tell you this, I'll give you a warning. Notice this wealth wheel. It's not where you stop. This is just maybe a good starting place for you, but it's not the end result. The end result is ultimately you got to have some passive investments that also work in tandem with this. I will tell you this, infinite banking by itself will not make you financially free. It can help you. It might even be better than the stock market in some ways. But I'm telling you this, is that it's not going to save you by itself. You need other passive income investments coming in, which I will also talk about today. Now, just so you know, the guys like Dave Ramsey, they don't get this stuff, right? They've been trying to tell you to set it and forget it and turn your brain off and just, pay off your debt and then save in those mutual funds and you'll be free someday. Here's the thing though. Dave Ramsey, do you know where he made all of his wealth? Do you know where almost all his money is stored? First off, he has about a $200 million net worth. 52 million, give or take, is the value of his business, right? His business was his number one investment that made him all the money, made him millions upon millions of dollars. And then where did he put those millions of dollars? Stock market. No, he didn't, right? I'm lying. Of course, I'm joking here. He did not put his money in the stock market. Despite what he tells you to do, he put his money into real estate. He has over $150 million real estate. His real estate's worth more than his own freaking business that makes literally into the tens of millions, if not hundreds of millions a year. There is where he made all of his wealth, not in the stock market. He has almost nothing in the stock market. Yet he tells you to do the same thing. Why? Because he thinks you're dumber than him. He thinks you're a lower denominator. You just need to do something stupid or simple, throw in the market, just turn your brain off, and that's going to work. But it hasn't, guys. Even Fidelity, when they do their numbers, less than 2% of people, only about 900,000 people have over $1 million. And of those people have $1 million, 35% of them, over a third of them say it'll take a miracle to be able to retire because they know having $1 million in the stock market means nothing. Because when you pull off 3% a year, you're living on 30,000 a year. It's just not enough. Okay. So I'll just tell you too, even with infinite banking, we're talking about this as a possible solution to store your money instead of locking away in prison in those IRAs and 401ks. Here's the issue though. Not all of them were created equal. And I know this from firsthand experience. And I'll tell you, I've had people show me stuff like, here's Northwestern Mutual. I'm putting 22 grand a year into it. Look, year one, I have $400. That means I paid 22 grand in costs when I could actually have tens of, really over 10,000, really $17,000 more in just that first year by reducing those costs, right? I even had another one. Somebody sent me this, and this is kind of like the policy I got sent because I bought a whole life policy in 2006 because I was meeting all these real estate investors. They said it was great. And I bought a policy that was kind of like the one on the left, not as big, right? I was putting in $1,000 a month, not 5,000 a month, but it looked just like that one on the left. Notice the one on the left, the first year it shows zero because she had already paid in $60,000. But notice that yellow highlighted area to the right of that a little bit shows zero. That means they paid $60,000 into it and all of it went to costs. Second year, if she pays another $60,000, all of it goes to insurance costs again. It goes to zero. Now, just so you know, infinite banking is using whole life insurance, not term insurance, not just death insurance, but whole life, which has a death benefit, but it also has this tax-free savings account inside of it. Now, if she, in her case, she bought the traditional policy just like I did. I was putting in $12,000 a year, and I asked the guy because I had an insurance license, but I didn't know how to do whole life stuff. That was not my forte. My forte was more in the stock market. So when I bought it on faith because everybody said he was a good guy. And I said, hey, $12,000 a year, and I have nothing in the first 2 years. Is there something we can do, pull certain levers so where I can have more cash early on? And his answer to me was, no, you can't. This is just how it is. It's front loaded, but then it gets cheaper over time. So once you get to that third year, you'll start to like it more. And it was her third year. She paid in $60,000 a year for 3 years. That's $180,000. And she finally has $30,000 in that third year. This was exactly what mine looked like, just divided by 5. Okay. And the crazy thing is though, of course, my third year was 2008 when the recession hit and I was going broke. I couldn't afford to keep paying the premiums. I couldn't stop paying the premiums because if I did, I lost the policy. So I stopped the premiums and I lost the policy. I paid 25 grand into it, had nothing to show for it. That would be like her paying in over 120 grand herself. And again, having nothing to show for it. Well, months later, I realized I did my own research. The insurance agent lied. You could actually do better. Much like what you see on the right there, $60,000 a year. This, by the way, this is the same exact insurance company for this as this woman has right now. Same company. It's not about the company as much, although that helps, but it's about how the agent designs these life insurance policies. Because again, she was just thinking, oh, I'm a neurosurgeon. I was going to keep packing money away and eventually I'll have some money here. By the way, it takes her 13 years to finally have as much money as she paid into it to have that much money in there. 13 years. You might be thinking, yeah, CD would be better than that. And you'd be 100% correct. Well, the way on the right-hand side though, notice put in 60,000, she would have over $50,000 in day one. By year 5, she has more than she paid into it. She paid 300,000, she has 308,000. The crazy thing is she has almost $1 million more just 25 years later than on the other side of what those guys were promising her, right? This is what I found out for myself. In fact, it got me so ticked. I had an argument with that agent. I said, listen, I found out I could have done it better. I could have done it the way I just showed you guys. And finally he just said, well, it's lower death benefit, yada, yada. Well, I showed him, I said, look, I got a higher death benefit down the road too, or about the same death benefit. There's no difference. So what you got now? His answer to me was, Chris, I had to do what I had to do because I couldn't afford to cut my commissions. That's the only way I make money. And I was like, there's the truth. There's the answer. And I kind of hate you now, right? I was pissed because I had put all this money into it and nothing to show for it, right? And that's kind of where I since this time, I've really been kind of screaming from the rooftops, so to speak, right? Really just telling people there is a better way to do this. I think infinite banking is a great concept. Even the traditional way is okay. But when Dave Ramsey says infinite banking is a ripoff, he's kind of right. He's right because when you look at those kind of policies, you're paying in tens of thousands of dollars and have nothing to show for it in those first few years, that is unnecessary. You do not have to choose that. It's all about how you can reduce those costs so then the cash can grow tax-free much faster, much earlier. And that's money you don't have to wait till retirement. You can actually use it right now. That's the difference. That's why a lot of times I refer to it as no BS infinite banking, because I'm tired of the BS out there. I'm tired of the stuff that they teach you about this kind of thing. Now, who's it not for? I'm not going to say this is for everybody because it's not like the too good to be true kind of stuff anyways, right? So one, it's not for anybody who, of course, doesn't have money to save. If you don't have, I would say at least $5,000 a year to save, don't do this. Just not worth it. If you have at least $5,000 a year, it could be good, right? So if you're paycheck to paycheck, I had somebody that asked me this recently. She's like, okay, I'm consolidating debt. I want to do this infinite banking thing you keep talking about. Is it time? And I said, well, what are you doing right now? She's like, well, I'm still trying to pay off that debt. It's still pretty crippling. I'm really paycheck to paycheck. I said, no, just do term insurance. And then she's like, well, I have term insurance right now and I'm paying $120 a month or $125 a month. I said, okay, cool. Tell me about it. And then we started to look at it, realized I can get her more insurance for less, for more like $70 a month. And so I said, guess what? We can even free up your cash flow that way and get you a cheaper term policy. And by the way, this term policy converts to a better infinite banking policy than what you could do with the term you have right now. So she's like, sign me up. I'm done. Right. Because she's like, that makes sense. Once I get the cash flow under control, then I can start paying into it and I don't have to requalify my health. By the way, she's in her 60s, but in perfect health right now. So she's like, I want to lock in my health today. So that's one. So again, if you're paycheck to paycheck, term insurance is great, but there could be a way to do it even better than just what you normally do. Two, I mentioned health. If you're in bad health right now, maybe you've had heart attacks or strokes or cancer recently, something like that, then yes, it may not be great for you. But do you have a healthier family member? We could put it on, because you could put it on spouses, you could put it on kids, you could put it on business partners or key employees, right? Shout out to you, Danielle, right? We're working on ours right now for our business. So we can do all that kind of stuff, right? So that's the kind of stuff that we can actually do. All right. So again, if you're in bad health, maybe you could do it on somebody else. Same thing if you're over the age of 70. It's not that you can't get a policy, but it's not going to be great for using it to create wealth with. It can be great to create a legacy to pass on wealth, but not so much to build up wealth, because it's just kind of getting late in that timeline. So if you're over the age of 70 or in bad health, well, then maybe we look at somebody else, right, and use on them. I had a guy that literally he wanted to put over 100 grand a year away, but he knew that his health was bad. So he used his wife, who is younger, healthier, and a woman, because women live longer. It was way cheaper, and he's stuffing money into her policy. By the way, I mentioned about protection from lawsuits of creditors. He has been sued, and yet nobody can get to that money. Speaking of those benefits, let's talk about that. So tax-free, it's tax-free now and later, much like a Roth IRA. You put in with after-tax dollars, money that you get after you get your paycheck. Use that money to go in, gross tax-free, comes out 100% tax-free, especially when you do it right. Also, there's no limits or penalties like you get with 401ks and IRAs. You don't have to wait till you're 59 and a half to get that 10% penalty. If you take it out earlier, you don't have that problem with this. There is no age minimum that you have to take it out at. In fact, you don't have to take it out at all. You can take it out whenever you want. You can even take it out in the first month, right? You've got so much more flexibility. And also, if you make too much money, a lot of people say, oh, I wish you could do a Roth, but they make it hard for me because I make over $250,000 a year, for example, right? Well, here, that's actually a good thing. The more you make gross pay, you can put in up to 25% of your gross annual income. Gross. I'll tell you, because we had a client recently where they claimed lower number based on their tax return. I said, you don't have to go off tax returns. They don't even look at that. They actually want to know what your gross pay is. What's all the money you're bringing in, not what you're trying to write off and make it look like you make less money for the IRS. We want to show more money. It's like trying to get a mortgage, right? You want to show higher income, not lower. So I said, show all of it. She's like, oh, well, it's not 210,000. I should make well over 350,000. I'm like, great. Because now you can pay in 60,000 a year, no problem. So perfect. You can do that. Really, if you make 400,000 a year, you could put in $100,000 a year. There's no cap there. I had one guy that his tax return showed only making 25,000 a year, because as a real estate investor, he writes off all of his income. But in reality, he's making about $1 million a year. So he's packing away $250,000 a year into his plan. And again, that money he can pull out and then go and invest in real estate. I mentioned already, it's protected from lawsuits of creditors 100% in most states. Somebody sues you and wins, they cannot get to this money. This is the beautiful thing, right? Because this money counts when you need it to count. Like if I want to go get a loan from a bank, I'll show them how much cash I have in my life insurance, and they'll count it. They count it as liquid reserves. But when it comes to if you get sued, the money doesn't count as an asset. By the way, when I try to get, for my daughter who just went to, my oldest daughter just is a freshman in college, for her, none of my assets, well, certain of my assets do count against her for getting financial aid, but my life insurance, I could literally have millions of dollars stored in my life insurance and it does not count against her for getting financial aid. By the way, we finally actually found a way to get her financial aid to where she's almost paying nothing out of pocket between that and her scholarship. So that was pretty cool too. So again, like good things you can use there. Also, it's safer than the bank. I mentioned this, like the banks have FDIC. We always hear about FDIC protecting your money. But did you know that FDIC only has about 1.5% of people's total bank balances? 1.5%. What happens if 10% of banks fail? This would be almost like 2020 again. Remember 2020, they're saying, oh, we're going to get these EIDL and PPP loans out. And then people were waiting for it and waiting for it. And it took a long time because they literally had to create more money out of thin air, which drove up our inflation because they can't create money out of thin air without causing inflation, right? This is what would happen if all of a sudden banks start failing. Your money isn't really protected. Now, you might say it's quote unquote protected, but you might be waiting some time before you can actually get access to it when you might need it the most, when everybody needs the most, right? That's why they don't want to have bank runs on the money and things like that. Well, FDIC only has 1.5% of reserves. But insurance companies, just like in the Great Depression, see, 2/3 of banks failed during the Great Depression, but insurance companies, only a small handful even failed. And even those that do, they have to buy it from another insurance company as protection. So insurance companies buy what's called reinsurance, which actually protects those insurance companies in case they ever default. And so if you ever do happen to have an insurance company that does go out of business, which is really rare because they don't over leverage themselves like banks do, if they happen to go out of business, that insurance company steps in, protects your money that's in there and your death benefit. So it's 100% protected that way, safer than a bank. But guess what? They're guaranteed to grow by at least 3% a year, but right now they're paying 6% or more per year right now. And again, that money is tax-free. Now think about that too, because a lot of times people say, well, I can make more money in the stock market. Maybe you could, but let me ask you this. What if you do make an 8% average return in the stock market? Right? Now, know this, unless you have your money in a Roth IRA, which then you're just using after-tax dollars anyways, but most time you can't put in enough into Roth IRAs because they don't let you contribute very much in those. But say you're putting money in 401ks and IRAs. Let's just say you do average 8%. Guess what happens down the road in however many years or decades when you retire? You get taxed, don't you? Do you realize that stocks have zero tax benefits? None. You can defer and delay your taxes till later, but here's the question you have to ask yourself. With the current Trump tax plan, which is one of the lowest tax rates we've had in the 110-year history of the federal tax rate, do you think taxes are going to go up in the future or down based on the trajectory we're at right now? Most people would probably say up, right? I don't know what you guys would think. Feel free to comment if you think differently or if you think the same. But I believe that there's a much more higher likelihood that taxes will go up. Why would I delay my taxes for a future date to only pay more in taxes down the road? Why would I do that? So let's just think, if you did happen to earn 8% in an IRA, right? Well, when you get taxed on it, let's just say your tax rate is 25%, could be more. Let's just say it's only 25%. Your net return, your net reality is only now 6% a year, isn't it? You earn 6% a year. Guess what? You can also earn 6% a year tax-free without all the market risk doing this. So could the stock market beat it? Sure, of course it could. But could this also be a good place to store your money and keep it safe, especially your emergency reserves, any cash you want to keep on hand? Heck, like Warren Buffett, what he's doing right now, trying to keep cash on hand. This is a great way to keep your money safe while still earning a lot more than 0.nothing% at your bank that you then get taxed on. And of course, you have access to that cash today, and it also protects your family and creates a legacy for you down the road. All right. You guys with me so far? Just checking in. Who's with me? Say yes. If you're lazy, type Y and no, whatever it might be. Just want to check and make sure you guys are still here because I want to talk about how do you actually use this now? What are ways you can use it today versus waiting forever? Okay, Jessica says, yep. Aaron's like, buckle up. Good. Terry's yes. Good. Terry from Seattle, good to see you. Or see your comment at least. I can't see your face. I'm not creepy like that right now. All right. Go into this first thing. Emergency reserve. Let me say that again. Emergency reserves, your emergency fund, right? Your savings, even for business. This is where I store most of my cash. Now, I do keep some money in the bank because I want to go in the bank today. And if I want to grab money out, I can. But understand that my bank, even right now, the savings account is still at 0.1%, that I then get taxed on that 0.1%. If I have $400,000 sitting there earning 0.1% a year, I make $400 a year, but then I have to report it to taxes. And I don't need one more dang tax form to report to my accountant. I hate that. And that means I only walk away with $300 a year. But what if I earmarked 300,000, which by the way, I'm doing, okay? 300,000 that's now earning 6% a year tax-free. Now I'm earning $18,000, not $300, 18,000, and I still have 100,000 split between my bank and a high yield savings account paying me around 3.5%, right? So now I'm still making more than $18,000 a year versus $300. Doesn't take much to realize that's a better deal, does it? Right? Even if you did nothing else of this, that would be huge. I know plenty of real estate investors that they'll literally just store millions of cash sitting here. They do nothing with it, but let it sit there just because they know that's safe, certain money that they have. I even had a dentist reach out to me recently. He's 72 years old. He said, Chris, I think I've done it all wrong. I was trying to put 100% of my money all into real estate. He's like, but then of course, those prices and things can fluctuate. Now that I need the income, and he even had some deals that went south. He did some bad deals there with another group. And so what happened is like he lost a good chunk of his money. His cash flow decreased a little bit. And he said, Chris, if I were to go back in time and do it again, I would probably store more money in my old whole life policies, keep money there that's safe, that I knew I could always count on. And it's like, that's not a bad philosophy. In fact, me being, about 25 years younger than you, I should probably listen to that advice for myself too, right? Greg from Alaska, good to see you're here too. So a great place to store emergency fund. It does take you about a week or so to get the money. So that's why I still keep money in the bank or in a high yield savings account that can take a couple of days to transfer. So I just diversify it, right? I diversify my savings. Collateral, you can actually use this as collateral to get loans. That's what Walt Disney did. He used it as collateral. He sold off one of his rental property, not a rental property, a vacation home. He sold off a vacation home and he put up the collateral from his life insurance so that ABC would step in with the rest of the funds to give him all the rest of the money to build Disneyland. He didn't have enough to do it himself. Banks thought he was insane, but ABC said, hey, we're struggling right now ourselves. Let's gamble on each other. And it paid off handsomely, didn't it? So that's what he used. He uses life insurance as a collateral, put it up as a cash, so then people would step in with more cash. I've had people do this buying buildings, buying their own office buildings. I had a guy that was a doctor that bought his own office building, putting collateral as cash. By the way, he was going to cash out his whole life insurance. He's like, I'm just going to cancel it. I don't even like my life insurance policy. I said, wait, you got 300 grand in here. Let's use this as extra collateral for the bank. And what happens is the bank lowered his interest rate significantly. His new payment was only like $1,800 a month. Once he got a renter in there, it paid his payment. He was in there with his business rent free. Everything he was paying himself was all profit. And even better is that after a year and a half, he went back to the bank and said, hey, I think there's enough value in this building. We can take the lien off my life insurance, right? And they said, yep. And then they left the interest rate just as low as it was before, keeping the same terms, which he would never have gotten that low had he just gotten a standard real estate loan. So you can use this collateral. It could be extra retirement income, right? Like you can literally create tax-free income and you don't have to wait till you're 59 and a half. I have one guy right now that his plan is to buy 1 or 2 rental properties every year, building up his cash until into his 30s. And then between the rental properties and then his life insurance, after only about 8 to 10 years, he's going to start pulling off for tax-free income from his life insurance. You don't have to wait till retirement. In fact, if you want to retire early, this would be the best vehicle to store cash in versus keeping it in 401ks and IRAs where they don't want you to retire early. They actually penalize you and tax you for pulling out that money early. This would be a much better place if you want earlier financial freedom. Kids' savings accounts, I mentioned my daughter, and whatnot. I mean, look at my daughter. She doesn't even need student loans, right? She doesn't even need the 529 plan. Well, all these people that get these 529 college savings plans are starting to hate them. For one, the stock market doesn't even return as well as the normal stock market. Usually the funds are horrible that you put your money in. 2, there's so little control. You have to use it. You ever notice that government plans, things like IRAs, 401ks, 403bs, 529 plans, all these things, right? You ever notice that they almost try to, again, go for the lowest common denominator? They want people to make it so simple that you're trapped. You have to only use it for one purpose and one purpose only, because they don't want you to have to think. So they give you only one purpose for it. Well, that 529 college savings plan, what happens if your kid decides not to go to college? What if they become an entrepreneur? What if they don't go to college? What if they get a full ride scholarship and you don't even need the cash? What happens then? You try to use it for anything else, they penalize you. They slap you with penalties, right? That's ridiculous. It was your money in the first place. But again, because you put it in their plans under their control and their rules, you have to follow them. Where now we're having a lot more people saying, either I'm going to put it in my own policy or even set policies on my kids, and I'm going to store it here. So no matter what happens, I have options. I can be really flexible here, right? I can be flexible. I can figure out where it can move based on whatever happens in the future because I don't have a crystal ball. Mine broke a long time ago. Yours probably did too, right? So might as well use it for something like this. And again, it's still tax free and it's under your control. So it's not even in their name. They don't even have access to it. You just use them as the insured if you ever buy a policy on them, right? But you control the money, you own it. You could give it to them later on. You could turn over ownership if you want, or keep it your own ownership. Trust me, I have 8 kids and everybody is different with money. There's some kids I would never trust with money, probably for years and years and years from now, versus others I might trust much sooner, right? Maybe in their 20s when some of their brain synapses start connecting finally when they hit 25 or so, right? You know how it is. Like if those you were that age at one point too, so like sometimes you're like, man, I was an idiot, right? I'm thinking like, when I was young in love and 22 years old, I'm like, man, I was so dumb, but I'm so glad I didn't have cash. I was broke back then. I was a broke college student, but if somebody threw cash on me, I probably would have blown it too. I'm much happier now that if I can choose when my kids can use that money, I can create a better legacy for them. Maybe I can give them a start to buying their first home. Maybe it's a wedding present. Maybe it's even well after that. Maybe it's after they get more established. And then I say, just so you know, you weren't even entitled to this. You didn't even know you had it. I'm going to gift you this money and check it out. It's got plenty of cash in there for you. So there's lots of ways to use it that way. Cash flowing investments. Let's talk about this really quick, right? Because this is the thing that we talk about here is how to make this whole wealth wheel work together. What's that wealth shortcut? You can also use this with investing now. It doesn't have to be retirement income down the road. It can be something to make money today. You don't have to let it sit there, right? That's the thing is that Warren Buffett says, if you don't find a way to make money when you sleep, you will work until you die. Just like I had to deal with my dad, you're going to be there forever. I have so many people that come to us saying, Chris, we've got a $2 million in net worth and I still can't stop working. Not because I don't want to, but because I have zero income coming in from all that net worth. Yeah, I have a paid off house. So what? Yeah, I've got all these mutual funds. So what? They don't really pay me anything. How do I make money on this? And even if I want to retire on it, then I'm going to put it in some crappy low yielding account so I don't lose my money in the market, right? That's why some people put the money in the market, but then if the market tanks, then they have less money to retire on. Then they're going back to work, working at Walmart or Costco or something, right? We don't want to be stuck in that position. So we got to find a way. How do we make this really work now? And this is where that double arbitrage comes in. Arbitrage is that where you can actually go to a bank. You know how you go in and you see their little reader board and you look at that, you see that 5-year CD come up and it says 5-year CD, 3%. And then the board switches again and it says, now it says 5-year car loan, 7%. You say, wait a minute, something changed, right? Trying to quote Brian Regan there, right? You're like, wait a minute. That means the bank borrows from me at 3%. They go into debt to me with my savings account, pay me 3%, but they're turning around making 7% of my money. And you might think to yourself, oh, they're making 4%. Not bad. And then you say, they're not making 4% because if that were a $10,000 car loan, guess what? That $10,000 car loan at 7%, $700, but it only cost using your money, your $10,000 only cost you $300. They made $400 off of the $300 they paid you. Really $700 total off the $300 they paid you. They netted $400, yes, but that's over 100% rate of return, isn't it? They made more than double the money off of you, not 4%, but over double because it's over double the interest. That's where they make their money. Oh, and by the way, they actually legally can loan out more than what they have in their own possession. That's why they can loan out up to 10 times than my money. So that means, imagine if you had 10 $10,000 car loans they did at 7%. Now they're making $70,000 in a year, right? Sorry, take that back. That's $7,000 in a year, but it only costs them $300. That's how banks make their money. What if we could turn the tables and we do it ourselves? What if we made the money instead? That's what infinite banking is for. Now, most people just take money out of savings or checking and they go and invest in an investment. And assume it's a cash flowing investment that creates returns. Well, when those returns come back in, it comes back and builds up that checking your savings account again. Then you have enough finally over however many months or years to then go and reinvest again, right? That's what you could do there, but you can also use it with the life insurance plan, with that tax-free savings account. You can do it, but better. Because instead of just pulling the money out, which you can do with life insurance, You could just withdraw the money. But remember, when you withdraw money out of your checking or savings, or even out of this infinite banking plan, if you just pull the money out, how much interest are you earning for pulling the money out? Nothing, right? You earn nothing on it. But what if you can actually say, well, what if I could still have the money sitting in there, still get access to funds that I need to go and invest, but it's not my money. So that money still stays there earning that 6% tax free. Then I can use some other money instead to go and invest, and then I can create income off that. That's how you can actually double dip. You can literally borrow the money as a line of credit against the cash, because the insurance company knows the cash is there, it's safe. So they'll lend you up to 95% of your money in there. They'll give you that line of credit you can use however you want. And the cool thing is this, there is no minimum monthly payment. You pay it back however, whenever you want. Your deadline for paying it back is your death. And what they do is take out your death benefit and then pay your family the rest tax-free. That's how they pay it themselves back. Why do they want to do that? Because they'll charge you interest. Now, this is one lie you'll hear in the infinite banking space. They'll say you pay yourself back interest. That's a lie. You do not pay yourself back interest. They charge you interest, but at the same time, you're still earning interest, tax-free interest on your money. And so you actually are being charged both ways. Some people say, well, why would I want to be charged on my own money? You're not. You're borrowing their money. You're getting charged interest for borrowing their money. But like I said, if you take the cash flow from those returns, use that money to pay down that line of credit, what happens is you got two different types of interest happening. You're earning compounding tax-free interest on the one hand, but you're paying them with only simple interest, and it's paying less and less interest over time as you pay it down. Let me give you an example, right? So we're just using the cash flow to pay that down. So say you buy a small apartment building, it's a $250,000 down payment, it's $1 million building, and it cash flows after everything is said and done, it profits $2,500 a month. That's $30,000 a year. Now, if you drained your savings account to do this apartment building, if you drained it, you would earn at that 0.1% in my savings account with my credit union, right? And after I pay taxes, guess how much I would earn after 9 years? After 9 years of getting that $30,000 a year coming in, that's $270,000 total, I earned a whopping $1,200 of interest. That's it. Because again, you drain your savings, then you're slowly building it back up. That 0.1% is barely paying you anything in the meantime, is it? So I only earned $1,200. But what if I instead use my life insurance policy? My money, that $250,000 still stays in there, still earns a compounding interest tax-free. But then I borrow from the insurance company, and then I use that $2,500 a month to start paying back that line of credit towards them. Again, I'm not required to do it, but I do that because I allow myself to have less and less interest. So I'm paying less and less interest while I'm compounding more and more. I create a spread. I actually make money here, and I'm still making money in the investment at the same time. What do I make in extra interest? $126,000. Guys, that's a freaking 100 times more after 9 years. And that's taking out the interest costs. And that's taking out even the fact that I still pay insurance costs that are coming out of my plan. But despite all of that, I'm still netting more, about 100 times more. I know it's a hard question to ask. What would you prefer to have? $1,200 or 126 grand? What would you prefer? Because what could you do with that 126 grand? Could you go and invest that and make more cash flow and passive income off that? The answer is 100% yes. But unfortunately, what do most people do? If you're lucky, this. Most of the time they're just using their checking accounts, right? But they're not even using this. They're just hoping to make interest, but they're just using their crappy little checking or savings accounts to invest. They just think I make money in one place and that's all I have. That's my only option. You have a choice. You have a choice. You can actually earn money in two places at once, which allows you to create more wealth. This is why so many people that own banks don't put their money in their own banks. They put it over here because they know it's safe, but they know they can also get extra leverage from it because they can still act like a bank with their own money, but then use that to leverage to create more wealth with it. Imagine you could lend your money out to somebody else. By the way, you can lend money in real estate. Did you know that? You can earn 10, 12% returns, lending your money out to them and having the property secure your investment. Rather than hoping and praying you might make 2.8 to 4.8% in the next 10 years, based if Vanguard's correct, right? That's a stock market. And that's if you even make money in the next 10 years. Who's to say it doesn't go down in 10 years, which is what happened from 2000 to 2010. What if that happens from 2020 to 2030 or 2025 to 2035? We could be seeing worse money or no money coming in. That's how you make money twice, guys. So again, the bigger picture is this. It's not just putting your money inside this infinite banking, or as we call it, max ROI infinite banking policy. It's then also use your money to create passive income. And as you build that passive income, guess what happens? Every time my clients say, wait, I've got more cash flow. What do I do with it? I can't put any more money in this policy. I've already maxed it out. Great. We just create another policy. We do it again and again and again and again. Keep building and building that cash flow, building your wealth to the point where you don't just create financial freedom for yourself. You start to create a massive legacy for generations to come. Does this make sense, guys? Aaron just said, buy a boat. You could buy a boat, unless I can get bank money for cheaper. Then I will use the bank money all day long and let my money do something else to invest, right? So really quick, again, going to this investing, here's my challenge to you is to get lean, get liquid, and get out, right? Get lean means start to really track your money, really understand what can I do? Because the true power obviously is how much money can you put away? But instead of locking away in prison in 401ks and IRAs, or locking away by trying to pay off your house faster, instead get that money in your possession by getting it liquid, right? So get lean, make sure you're a wise steward of the money you're spending, try to find ways to earn more income as well. So then you have more cash to use to then get liquid, and then you get it out to invest in other places, primarily in places that generate passive income right now. That's the secret. Where are places you can get liquid, where you can find money? Bank savings accounts, obviously. Life insurance cash value. Do you know how many people we've had that have old policies that were said, we can use this money to invest? They said, you can? I thought we had to wait till retirement. I'm like, no, that's what they trained you to think, but you can use that money right now if it's even worth keeping in that policy. By the way, if you have a bad policy or you're not sure if your policy is good, be sure to scan that QR code. You can actually book a time to review it to see how it compares to your current path with the one you have versus what you could be doing. Sometimes you might want to stay the same. Other times you might not. Other times you might want to do something different. I'll throw up that actual link that's there. That's not the QR code. But again, you can use life insurance cash value, mutual funds. People often cash out mutual funds saying, now I can get it out of this taxable place. Let's get into a tax-free place. How about old 401ks? Not the current 401ks. It's locked up while you're employed at that company. You have to either get laid off or quit, which I don't recommend doing. But old 401ks and IRAs you can use to invest and do things with as well. Rental properties, not just because you have a rental property, but a lot of times I see people that actually have a rental property that's not cash flowing as much as it should. What if you could take the equity from that property and use that to invest and make bigger returns than what you're making right now? Home equity is another one. Home equity. We actually just have a guy that's going to come out on a podcast again about how you can access your home equity without any debt payments or without having to sell your home. And then, of course, gold, silver, or crypto. Those of you guys that got the good old Bitcoin, you'd be like, crap, I knew I should have sold a couple weeks ago, right? That's one of those places we've told all our clients, like, listen, you've got crypto. That's a potential storage you can use to then generate passive income. Because the truth is, your crypto is not generating any income, but you could be using it to generate income right now. Same thing with gold and silver. Some people they're hoarding gold and silver. And I love gold and silver too. But again, could you get that money to actually create passive income for you now? Places you can put your money. I'm not going to go into depth on this. I did another masterclass a few weeks ago on this topic. But there's turnkey rentals, right? You can actually get a property manager to manage the rental for you, and you can have it anywhere in the country. You can lend out your money and get paid on that. Like I mentioned, you can be the lender, like the bank, for real estate investors. You can put your money in different funds so you can have it more diversified, maybe in a certain type of class of real estate investments. Sometimes even with lending. There's apartment buildings, there's self-storage. You can even do, oil and gas, oil and mineral rights and things like that. Partnerships. I've got a raw land partnership that's now paying over $13,000 a month. I should probably double check. It might be over 14 now, but I haven't looked at it in a few weeks. But those kind of things, you can be doing all that kind of stuff to generate more income right now. So here's the path. Here's how it works. One is start by opening up a policy. Just start with the policy, especially if you can save at least $5,000 a year. Start with opening a policy. Again, I'll give you the QR code of how to do that. Two, fund that policy with your savings accounts. Don't even worry about using it with your investment money right now. I'll show you what I mean in a second, but use your savings accounts to fund it. Then, as you start to build it up, especially over the years, then you can actually start using that money to invest for passive income. Now, yes, you can do it from day one. I'm going to show you a different method I think would work better for you so that you can actually get this real fast, tax-free supercharged savings account. Then use the cash flow to pay down that loan, as I mentioned, right? So as you start to invest for passive income, take the passive income to pay down the line of credit. Because what happens when you pay down that line of credit with the life insurance? It frees up more cash to then do it again, right? Ooh, that thing just moved on its own. That was weird. I use the force. Yeah. So you do that and you just keep repeating the process, and that's how you become work optional. That's how you have enough passive income to pay your bills. So then you work because you want to, not because you have to. All right. I'll tell you, like I had one person, we actually did look at his policies. I didn't think we should have to do anything with it because I thought he'd had it for like 6 or 7 years. I figured by this point he paid his dues. It probably wasn't worth changing. But he said, Chris, can you look at it anyways? And when I did, apples to apples, the money that he and his wife were putting in their policies, we were able to make them an extra 2.25 million over the next 20 years by paying nothing more than they already had been. 2.25 million. How many of you guys would love to have $2.25 million more that you could apply, even if you don't invest it? Heck, even just to have 2.25 million would be pretty nice, wouldn't it? It literally would have them 2.25 million more. And just so you know, because again, those insurance agents will always say, well, you lost a death benefit. No, they would have $4 million of death benefit too. It was way, way better. Again, it wasn't about the company per se. It was about the insurance agent not just doing the best thing every time. Because again, those insurance agents need the money. That's where they make their money. All right, as promised, here's the code you can scan here. So you can get that free consult. Even if you have a policy, like I said, we can even review that for you. In fact, I just did that with a guy that is a really great business owner that I respect. He had a policy. He loves this stuff. He's been using it for years. But after we reviewed it, found out, guess what? After 4 years, we can actually have more money in these policies that we set up versus the one you're already in, even though you paid those extra costs up front. So we end up changing him and his whole family over and going to something better. And because it was better, the crazy thing is, guys, he actually said, I'm going to put away more money per year because I'm getting a better return on that money. I'm going to do more. So he actually did bigger policies than even he did initially because he realized he was going to have cash from day one, right? So there's the QR code. There's the little bit.ly link again that you can use to take a little screenshot or something if you want that as well. All right, so just to show you reasons why people use it. We had one guy that's a real estate investor. He just didn't want exposure to banks. He wanted that creditor protection. He didn't want anybody to take away with lawsuits and whatnot. My client on the right hand, Ron, he's actually a real estate investor too. He actually owns a real estate company. He actually's like, I want a place I can keep my money, keep it safe, and do better than what the banks are doing, and it's safer. He's like, I know that my money's safer here. This guy is actually a dentist that he said, man, I wish I knew about this like 20 years ago. I can't tell you how many clients we have. By the way, he's in his 60s. So people say, well, I'm 55 years old. Am I too old? No, because him and even the next guy here, Daniel, in their 60s, right? They've been doing this they're now doing it in their 60s. Daniel wanted that double dip. He wanted to be able to make the money in two places at once. That was his big reason, right? So many different reasons, but that's the great news that it's so flexible. But this is also why it's so confusing for people because they realize, but I don't have just that one path like the government trained me to do. I just turn my brain off and do one thing. I'm like an automaton. No, you can actually use your brain and then do cool stuff. And even better, guys, I get a lot of people say, well, yeah, but am I ready to invest yet? Maybe I don't have enough money to invest. That's fine. Because anybody who sets up a policy with us also gets access to our Wealth Accelerator Academy, where I teach exactly the same thing I teach our 101 VIP clients, the ones that pay us for consulting. You get access to that same education, teaching you like not just about ways to free up cash flow, save on taxes, pay off debt faster, but even ways like, how do I know what's a good investment or not? How do I create passive income? Where are those places I can put my money? We teach that in that as well. That comes for free whenever you set up a policy with us. So that's kind of a cool bonus that you get. So anyways, whole point is this is unbank yourself. And notice we hardly even talked about the death benefit, did we? Even though that's a great thing, you can get tax-free for your family. Notice that that's almost becoming a bonus, like extra icing on the cake. How many of you guys might be wasting money on term insurance? Like the guy that's the CPA for Rich Dad, Poor Dad. If you ever read that book, Tom Wheelwright, he actually says, if you buy term insurance, you're buying an expense. When you buy whole life insurance, you buy an asset, right? And you can now see why that's the case. So anyways, I'm going back to my dad here to wrap this up. By the way, if you have questions, start typing them in now because it takes about a minute for your question to show up. Anything you feel like you need clarity on, type them in now. But let me just kind of finish up with my dad here because my dad, although we all thought he'd be dead before 70, he's now turning 81 this year, guys. He's still alive. But remember, because this guy had to work into his 70s, right? He did the traditional path. He did everything right and had to keep working to his 70s until he was forced into retirement due to health reasons. And now, since then, he's been stretching out his dollars, trying not to run out of money the entire time. This is where you can be alive, but you're not really living the life that you wanted. You know what I mean when I say that? You can be alive, but not live the life that you want, right? The life that you want to live. You're not living, not the way you truly wanted. That's what happened with him, guys. He got to the point where now health-wise, he really can't leave the house much, right? He has to have a caretaker all the time. And that's the thing. Like, I'm grateful he's alive, right? There's no doubt. And I'll tell you, he's taught me so many good things. I love the fact that he taught me growing up, not just about scarcity of money, right? That obviously was what drove me where I am today. But he taught me that your word is your bond, right? That you work hard. You don't do anything half-assed, as he says, right? You do what you say you're going to do and have that integrity. Those are the values. That's a legacy that I want to pass on from him. But now I'm also grateful I can stop. I can create a change in the pattern of our family legacy where it's just barely passing on whatever might be left if you die too soon or too late, if there's anything left, right? We don't worry about that because now we're creating wealth today. Now my generation, my kids have a much different life to look forward to. Not that I'm creating entitled, spoiled brats or trust fund babies. No, because with my life insurance, I can actually create it within a trust. The trust then dictates how and when they get the money, right? So there's so many cool things you can do with that. That's the kind of legacy that I want to leave. I want to pass on the stuff my dad taught me, but I also want to pass on that abundance mentality, that ability to create more wealth today so that they can even be wealthier than I was at their age. That's the kind of legacy I want to leave behind. So remember, guys, the most dangerous risk of all is the risk of spending your life not doing what you want on the bet you can buy yourself the freedom to do it later. Our days are numbered and we don't know how long that is. But what we do know is that we can actually affect today. You can make a change today. The question is, what are you going to do with that? Are you going to make a change? Or are you just going to sit around and just let the life, just see if that's going to work out? Even though tens of millions of people aren't seeing it work, you figured, hey, I'm just going to see if that works too. That's the definition of insanity. Doing the same thing over and over, expecting a different result. Do something different. And again, I'll leave that QR code up for you guys right now. Questions. Let's again open up for questions. Type in your questions. I wish I could see you. I can't. But I know there's several of you guys on right now live. I know some of you are also watching this later. If you're watching this later, you can also type in questions on the video later on too. But give us questions. What questions you guys have here? Greg, amen to that, right? Our days are numbered. I just wish I knew how many days it were because it'd make it so much easier to plan, wouldn't it? But again, we just don't know. And that's all we can do is affect today. This is why I'm so passionate about passive income, is because I don't know how many days I have left, but I do know that if I create passive income now, my life changes today. I lock my money out in prison, in my house, or into my 401ks and IRAs. All I'm doing is taking money away from my family, but nothing ever comes back until hopefully down the road, if I'm alive long enough. Well, Steve, I appreciate that too. Thank you as well for being a part of this. All right, guys. Well, I'm just going to end it here. I know we're at the top of the hour and everything, so appreciate you guys being on. Again, if we can serve you anyways, this is definitely what we can do to help you here. There's the link as well. If you had a previous consult, Greg, to answer your question, if you're ready to move forward, who should you call? Just email us back out again. You can even email me, chris@moneyripples.com, and say, hey, who was I talking to? We can get you matched up to whoever you were talking to. So definitely appreciate you guys being a part of this. Go and make it a great day. And again, let's see if we can change your life. And I'd love to be a part of it. Thank you for letting us serve you and create value in your life today. We'll see you.